Federal Reserve Chair Janet Yellen's speech on the economic outlook of the U.S. indicated interest rates are still going to go up this year as planned, as long as the economy improves.
With oil prices no longer declining, and with the public's expectations of future inflation apparently stable, my colleagues on the Federal Open Market Committee and I believe that consumer price inflation will move up to 2% as the economy strengthens further.
Analysts have been expecting a hike, as officials have been saying for years that rates eventually must rise. But until now, no one knew if the rates would go up in 2015 or later. And of course, Wall Street is very sensitive to interest rate changes. Just the mention that equities were highly priced in a May speech by Yellen was enough to cause some waves in the market at the time. And that puts the Fed in a tough spot. One analyst told Bloomberg that the Fed is essentially stuck between a rock and a hard place on raising interest rates.
I think the Fed is trapped. They are painted into a corner. Now you're in a situation where they need to raise rates. We have to restore income to the system. And at the same time, they don't see the growth that they want to see to validate that change.
With interest rates going up sooner rather than later, that means the Fed must at least be somewhat comfortable with how the U.S. economy is doing and believe it can handle a rise in interest rates. The market was stable shortly after Yellen's speech, with Standard & Poor's 500, the Dow Jones Industrial Average, and the NASDAQ Composite all virtually unchanged. For Newsy, I'm Cliff Judy.